All right, guys. Once again, welcome to my Stock Investing Simplified show. Not my show. I'm just continuing on my original goal, which is simple: to make you rich by showing you the right stock to put your money in, to buy and hold, and then wait for it to appreciate in value. Minimum waiting period, I recommend 5 years. But you can do 3 years. If the stock appreciates in value, of course, it will eventually, majority of your stock will appreciate in value. And depending on your goal, if you are looking for it to double before you sell it, then if you're lucky, it might double, but it's going to appreciate in value. Usually 5 years, if it doesn't double in value, you can sell, make a profit. But if you feel that the stock is still going to appreciate even more when you go into more fundamentals and read anything you can lay your hands on about the company, and you believe that it's going to go even higher, you can keep it. People like Warren Buffett, Charlie Munger, sometimes they hold their stock for up to 10 years. And they are among the richest investors in the world. So remember, this show is not for those who buy today and sell tomorrow, or who buy this month and sell next month. It is only for those people who really know what they want by doing the fundamental analysis, which I'm going to show you, so you don't have to do any work. Just look at the fundamentals, look at the company, look at anything that you can get your hands on about the company. And if it looks good, buy it, hold it. 2 years, 5 years, then you look at your stock. So which means that no matter what the market is doing, if market is going crazy, it doesn't concern you, because what? You are a long-term investor. So what market is doing today is none of your business. Okay, so I'm going to show you now. Tonight, today, our stock of interest will be what we call a company that is called SentineOne. So I'm going to show you today if it is a good stock to put your money in or not. So once again, put your ears to the ground to listen to a great financial wisdom about this company. Let's begin. Now, as you can see from the screen, SentineOne is an American cybersecurity company and based in Mountain View, California. The founders, Thomas, sorry, I'm bad with last names. But what I see is his name is Thomas Wengarin, Almog Cohen, and Ehud Shammai. They founded the company in 2013. Now, as you all know, cybersecurity is a big deal these days because everything is migrating online. Everything is going online. So now, as everything moves online, so also are the cyber criminals. It's like they're having a heyday. So your best bet is to figure out a way to protect your system, which means that you are going to need the services of a cyber security company like SentineOne. That is one good point about the company. So my analysis about this company will be based on 3 things again. Some of the information I got from the balance sheet, income statements, cash flow statements, then of course the company's stock information. So now let's go to where we can get those information free of charge. As always, it is in Yahoo Finance. SentineOne, the trading symbol is S. I'm going to type S here. You can see that the company pops out. So I'm gonna click on it. Okay, so far the stock is $28.30 per share. Not bad. I mean, it's a good. It has a large room to grow. So if you can buy it, more investors can buy it at this price, and then wait for it to grow. Now, you'll see that. Let's look at the chart, so that we can see the moving average. So, as usual, the stock have a wide swings starting from October of 2023 to the current year. So let me insert a 5-year moving average. Okay, I'm gonna insert, sorry, a 200-day moving average by mistake. Make it 200 days moving average for a 5-year period. Okay. Now I couldn't see. I don't know why it's doing this. Come on, not today. Okay, 200. I'm gonna save it. Make it a simple moving average. Okay. Why is it coming back to 200? Okay. For some reason, the system is not responding to this. I don't know why it's doing it. Let me try it again. Moving average. Let me try 50 days. Okay, 50 days worked. So let me change it to 200 then. Okay. 200 didn't work. I probably, since 200 did not work, let's try 50-day moving average then. Maybe because the company have not been it's been around for a long time. Sometimes technology can act weird. So let me go back to two years and then try 200 days moving average again. See what happens. Okay. Didn't work. Okay, let me try the 50 days moving average, see if that one works. So for some reason, SentineOne is only accepting 50-day moving average. But the thing is this, let me make it 5 years, see how it works. So far, for the past, since July of 2023, it had been trading below its moving average. But after October of 2023, it started to trade above its moving average. So you have like a kind of a reversal from 2023 July to the October of 2023. It now changed and started trading above its moving average. So this is a good entry point. I mean, if you want to enter, if you want to buy the stock, this is a good time to buy it. Now, so you have for moving average, you have a mixed signal. Some part of it was trading below moving average, some part above. But the thing that because of this, the moving average will only tell us in this case when to buy the right time to buy the stock, which is the time when it started to appreciate in value. Okay. Now let's look for other things that we can learn about this company. We're going to be looking at the statistics. Okay. Statistics. All right, let's look at this. Profitability, for example, you can see that it has a negative profit margin of 62.89%. That does not look good. So it means that the company is currently unprofitable. Okay, because it's negative 62. That's a lot of losses. And the high negative margin indicates the company is spending significantly more than it earns. Now, if we look at the management effectiveness, here we have a return on asset of negative 11.13%, return on equity of negative 22.09%. Well, these two values, they indicate, one is that for the return on assets of negative 11.12% indicates inefficient use of assets. And the operating margin of negative 49, operating margin of, no, sorry, a mistake. So, return on equity of negative 22.09% indicates that the shareholders' equity is not generating positive return. Okay. Now let's look at what the income statement says. Where it said that it has a revenue of 573.08 million, and revenue per share of 1.97. Well, what can we say? Given all these negative values we have on the return on assets and return on equity and the profit margin, let's look at what this number means then. It says quarterly revenue growth of 42.4%. Well, that value and is year-over-year quarterly growth rate. So it suggests that the SentineOne is expanding its business operations. The net income, which is a fancy name for net profit, is negative 360%, 360.39 billion. What does this mean? It means that SentineOne is facing significant challenges in reaching profitability. Okay. Under the balance sheet, I'll be looking at two things. Actually, three things. First one is the total cash, 797.97 million. It is a healthy cash reserve, because it is positive. It's positive for its financial stability. The debt level of total debt of 22.94 million is a low debt level, and the debt to equity ratio of 1.45%. The company appears to have manageable debt levels. Then the current ratio of 2.14% is good. 2.14%, 2.14 for current ratio. Of course, it means that the company can, if they have $1 in debt, they can handle it. They can handle their debts. Well, so okay, if they can handle their debt, that's not it's a good sign. So 2.14 indicates that the company have sufficient liquidity to meet their short-term obligations. The short-term obligations, those short-term obligations are usually the thing that derail a company. Short-term obligation might include the salary to workers, payment to suppliers, the utility bills, rental space, and so many other things. So, and you pay them month by month. So if your company can meet up with those short-term obligations, no matter how profitable they are, they can go bankrupt. So now, next thing is the cash flow statement. The cash flow statement, it says operating cash flow is negative 84.26%, which is a concern because it reflects challenges in generating cash from business operations. And the levered cash flow of 101.78 million, in contrast to the cash flow from operations, it is a good sign because it's positive and suggests that the company is still able to generate cash after paying off debt obligations. So for long-term investors, what does this mean? It means that SentineOne, it has significant revenue growth, and that is a positive indicator for potential profitability. Not only that, the company's strong cash position and manageable debt level provide some financial stability. Okay. Yeah, because you have a debt ratio, current ratio of 2.14 and debt of 22.94. So, I mean, it has a manageable debt level, which is very, very important. Now, but the problem is this: SentineOne's current lack of profitability, negative margins, and negative return on assets and equity are concerned. So for long-term investors, the current figures suggest that SentineOne, SentineOne is likely in a growth phase. Yes, it's a company that is, sometimes when a company is growing, investing in growth, they might have some of these negative values, negative return on asset, negative because they keep investing. Plus, the company have a manageable debt level, good cash position. So this it might be that the company is growing. So this the value we have, it means that it is in a growth phase and it is investing heavily in expanding its operation. Now, the negative profitability indicators and cash flow concern might discourage some conservative investors in seeking immediate returns. But the strong revenue growth and solid balance sheet might attract investors who are willing to, tolerate short-term. I mean, if you are the kind of investor who is willing to tolerate short-term losses and to gain in future, then you should not be too worried about it because, of course, you have a good cash position and have manageable debt level. So it's basically it is in an expanding phase. So what I can say about this company is that SentineOne is that the company stock represents a high risk, potentially high reward opportunity for long-term investors. It's a high risk, and high reward opportunity for long-term investors. Not only that, the company's growth trajectory is promising, but its current lack of profitability and operational efficiency can be a significant risk. So for long-term investors, I mean, this company has positive and negatives, mixed signals, based on what I've seen so far. It has mixed signals, but I'm seeing it as a company that has potential, given that it has a manageable debt level and a good cash position, and probably it is in a growing space, expanding stage, growth stage. Every company goes through that. Amazon was not profitable for years before it became profitable. So I recommend this company. So my final conclusion for this company is that should you buy or sell? I would say buy. Okay, buy SentineOne and hold it for at least 5 years. Okay, that's my recommendation. Thank you for listening. I hope you enjoy the show, and then I will see you in my next presentation. Bye.